Welcome to Global Beta Advisors educational video channel. One of the things we want to do today is talk about valuations in the stock market, particularly looking at some of the Bitcoin, Tesla, the whole growth market. And where do we get the expertise to talk about that? Our firm has created multiple custom indexes with Standard & Poor and other index providers. And the main goal of our strategy is to take factors such as value or growth and extract from the index that growth factor or that value factor and apply our methodology to the basket of stocks of 50 to 100 stocks representing value or representing growth. And our methodology will then arrange those stocks in such a way that you will own that factor with a price to sales less than the index itself. Why do we do that? There's a very good reason. Our research has told us that if you own a basket of stocks today, similar to another basket of stocks today, and the price of sales of your basket is substantially less than the price of sales of the general index basket, your forward-looking return over the next 5 and 10 years, you have a much higher probability of outperforming the higher price to sales basket than the lower price to sales basket. So with that said, let's look at today's bubbles that are out there, or very high price to sales stocks, Bitcoin. Let's take a look at them in today's market to determine where we are in terms of valuation and what that means. Okay, let's take a look at one of my favorite value stocks. Marathon Oil Corporation. It's a company that's more than 100 years old. Let's take a look at their history. I use QuickFS. I'm not being paid by them. I like using their information and I subscribe to them. So that's the source of this data. Here's the look back to 2011, 2012, all the way up to 2020. So Marathon Oil is now what we would call almost a small cap value stock. But in 2011, it was not when oil prices were up around $100 a share, anywhere from $80 to $105 a share during that period of time. And the revenues were $14.7 billion, or to be exact, $14,666,900. So this is in millions. We can see the cost and the whole income statement. And they had lots of earnings, lots of revenue. And the stock price at this time at one point had gotten up to close to $40 a share by 2012, 2013, but it was $25, $30, $35, $40 a share during this whole period of time. And then oil prices start to come down a little bit. And it's pretty amazing, even though oil prices come down a little bit, we're in the denial phase, because actually right here, oil was in a bubble. And so there was denial, and the stock actually continued to go up during this period of time. Now, as we go across, we can see that oil began to collapse, and the price of oil fell dramatically down towards a legitimate $20 barrel. Forget about the future prices that went to negative. That's a whole other story. But the actual cost per barrel got into right around this time frame of the early part of the year of 2020. We saw oil prices get down to $20 a barrel. Now for Marathon Oil, which is it's a Texas-based firm with large reservoirs of natural gas and oil, and they're producers of those products, and they deliver them, to the rest of the world. If you consider that oil prices went from $100 down to $20 a barrel, you can see this doesn't take a lot to figure out the rationale behind, what was going on here. Now that at this point, you're talking about oil being in the $20 or $30 a barrel. So they really destroyed the stock. It went down to like $3 a share, moved back up to $5. So that is what we would call valuation. The issue is their client base, which is not just all of us, but it's the price of oil. So now that the price of oil is back up to 60, let's take a look at some of the, whether the markets, it's in the quiet period now, because we're not seeing the stock go up much. It did make a run to 11. Right now it's in the $10, $10.50 range, as we speak here in the middle of April of 2021. But let's take a look down here to a couple of the capitalization of the company. Back in 11, that hit the 20 billion. So if you go back to the Graham and Dodd concept of intrinsic value, if you could buy the stock at or around 20, the per share would not exceed the market capitalization per share. So you would divide the number of shares into 20 billion and you could get some real value. Of course, the capitalization was much higher than 20 billion here. But as the stock has come down, and we're down to 5.2 billion here, even when the stock price was at around $5 a share, you had the real capitalization, going down to here. But the intrinsic value, if you look and really think about where oil prices rebounded to, and you go back to here, you realize that the stock in 2020, late 2020, early 2021 was really trading at significant discount. And even at $10, if you were to took like an estimated economic value right now, it would probably be around $11 to $12 a share. So it's still slightly under. So why do we look at that? Well, let's take a look at Tesla, TSLA, and here's a new era and a new concept stock. Incredible growth in revenues. People are so excited about this. It went from the 204 million in 2011 to 31 billion by the end of 2020. And we're not sure where it is. I did talk to one fellow that ordered a Tesla back in, again, this is April, ordered in October, and he still hasn't been able to get it. So not only is there a backlog, there's a question of whether or not Tesla can deliver the demand that they have. So it is clearly a great company that has a really, really good future. But the question is it really a good stock? Let's take a look. Let me go back to my key ratios, and here you have a stock that has a market capitalization of $764 billion. It's almost a value of $1 trillion. Okay, think about that. It's $1 trillion. Let me just run back real quick to the income statement. And you have 31 billion in 31.5 billion in total revenues. Impressive, and the growth is there. But if you look at this, you are paying right here $24.23 in stock price for every $1 in revenues. So you're basically buying around 24 years worth of stock. That is one of the highest PE levels I've seen for a first-class company. It has to make you wonder. So you have price to earnings of 1,107. This is beginning to look to me very much like the bubble, because they're using rationale. You see ARK Investments and others talking about this is a new era. This is going to be a $20 billion market. So you have a nearly $1 trillion company, and it's over $1 trillion at this point. You have 34 billion in revenues. Again, we believe this is a bubble. So let's go to the broader part of the market, and let's compare what the various factors are, and let's look at all the factors that make up the S&P 1500. Let's pull out of there the various valuation levels of each factor, and we can drive our point home a little bit more by looking at that. Now on the screen, we have FactSet's research systems that we use, looking between the end of 1999, catching the last bubble, through the end of March, first quarter of 2021. And what we were able to do is we have the S&P 500 and the various components of the S&P 500, such as low volatility, growth, value, dividend yield, quality factor, the momentum factor, the size factor, and of course the index itself. But this is only a 1-year return. So if you think about this, what we were able to do is take these factors during the initial part of an inflation period. When inflation starts to rise, when it begins to rise and it moves into a clear pattern where it's rising, this is the 1-year forward-looking return. So we were able to go back and let's say it's 2004. We're able to capture those periods where inflation was coming back, and what did the different factors within the overall market, in this case the S&P 500, and well actually it's 1500 because we put size in there as well, as you can see. So we're able to isolate the large, the size, and extract these multiple factors. And factors mean low volatility is basically isolated by what are roughly the top 100 stocks in the S&P 500 with the lowest volatility over some period of time. And then the growth factor tends to be a system created by S&P to identify growth stocks. In this case, we use our own methodology along with FactSet to help us extract growth. And in this case, I believe what we're using here is the S&P's factor for growth, as well as for value and yield and quality and momentum and so on. These are not our factors. We create our own factors. These are actually the factors as created by S&P, and we've extracted them out. So this is the 1-year forward-looking return when inflation comes back. So low volatility is a great place to have exposure. Yield is a great place to have exposure. Quality, that quality tends to be analyzed by the quality of the earnings, the quality of the revenues, and there's an extensive scenario. Famine French really started these ideas, but S&P has identified how to create quality, but it has everything to do with the quality of the earnings and the quality of the revenues and other factors that go into it. Momentum is just the flow of money going into a stock, and is it going up or is it going down? And momentum is a very serious and very effective factor, and you got to pay attention to it because we are, for the last 10 years, have been in a momentum market. Now, momentum will probably want to be the top losers if inflation comes back. So all those momentum stocks that you've been in, all the growth stocks, all the tech stocks, history tells us they could have trouble. Size, small cap, mid cap, they do quite well when inflation comes. A lot of the rationale around that is small companies are able to pass on price increases that hits their bottom line. So inflation is actually really good for small companies to a point. This is just the beginning, the first year. The response is strong. So all these factors tend to outperform the market as a whole. So that's an important feature here that we're looking at. And now let's take a look at the 5-year analysis of each factor when inflation returns. Same sources here. We have the long-term low volatility, yield, quality, and size. Again, it remains remarkably consistent with the 1 year. See the 1 year? But there's a reason for it. It's because right now, if you have the right low volatility, not all of them, but the indexes that we follow, we create a lower price to sales, low vol index. The growth index or growth factor right now is at one of the highest levels ever recorded. It even exceeds 1999. Owning a low price to sales versus a high price to sales, even a broad value is going to outperform the market and growth. But if you can zero in on things like yield, which has a very low price to sales, very low compared to the market, down around 1. And we'll get into these price to sales for each factor as we go forward. And then we have the quality, tends to always do well, but this quality has to have a lower price to sales as well. and then we have size. Size is at some of the lowest levels it has been since the early 1980s. So this is the general concept. If you want to invest in the market now, we believe these are the factors that you should overweight. And we'll give you some ideas how to do that and as we look forward. So to conclude, if you all recall the analysis that I did between Marathon Oil and Tesla, that was done in the first quarter of 2021, and Tesla was riding pretty high. So let me tell you where we are at the close of the stock market in the US as of May 17th, 2021. On January 1, 2021, Marathon Oil was trading at $6.78 as it opened. It closed on 5/17/2021 at $12.27. Tesla closed on January 1 at $7.19.76, and as of the 17th of May 2021, it closed at $576.73. So you can see the enormous difference between the two of them in the returns, and it's rare if anyone would have picked Marathon over Tesla in January. But if you use the old valuations of intrinsic value we had spoke about earlier, and I think that you would find that it's a much better valuation. It's a much better way to invest your money. And you can take a look at our global beta index strategies that we have with S&P that manages the various styles, and we do it in such a way to keep the price to sales lower. We want to own everything, but we don't want to own a lot of overpriced. We want to own more companies that have better intrinsic values. So visit our website, and if you really get excited, you may want to look at our website where we have our exchange traded funds website, Global Beta Exchange Traded Funds. Thank you for watching, and if you liked our video, give us a like. Thank you.